Hi, everyone. This is Brittany Button, long-term care insurance specialist for Art Jetter and Company. We also have Brent DeGroot, regional marketing director of OneAmerica, with us. So today, we are going to be reviewing OneAmerica's annuity care portfolio. Now, this isn't just product training. We want to also show you some sales opportunity that just may be what your clients are looking for. Now, we have included some handouts, so make sure to download those prior to the end of the presentation. Also, at the end of the session, we want to answer any and all questions you may have. Simply type those into either the chat or questions box, and again, we'll address those at the end. So, Brent, let's get started.
Well, thank you, Brittany. I certainly appreciate the introduction there, and thank you all for coming out today. I wanted to show you that, hey, yes, I am live here, so put my camera on for a minute, but nobody really wants to stare at me the whole time. So I'm just going to say hello and turn that off. So bear with me just a moment. All right, and let's get in and talk about some planning with annuities. As Brittany said, I'm regional account director for OneAmerica, but that's not why you're here. And I also wanted to talk about OneAmerica just overall as a company, because some of you may have heard of us, some of you may have not. Our paper that these accounts are written on is actually State Life, but it's all under our parent company, the umbrella of OneAmerica. So wanted to quickly mention that, but we are a leader in this asset-based market space, if you will. So planning for long-term care with an asset-based approach. Today is going to be all focused on annuities, but we've got a life chassis as well. But why are we a leader? Well, I certainly want to hit on some of that. Our financial strength, you can trace our roots all the way back to 1877. We're A+ rated from AM Best. Current Comdex is 95. So you don't have to worry about any of the, representing us to your clientele, because we've got all the financial strength that is there, that is needed. We are a mutual company, and that's where really we're finding most of the long-term care planning options, solutions from the various carriers out there. Most of them are mutual companies as well. And like I said, we're a leader, but it's not because just of the types of planning that we do, but we were also one of the first to market with these types of asset-based solutions. As a matter of fact, our asset care, which is our life-based chassis, was first released in 1988. So we've been doing this a long time. 35 plus years in experience, and really it takes about 30 years from app issue to actually somebody being on claims. So we're 5, 6, 7 cycles, if you will, into claims, and that's really what you're making the promise, or the promises that we are guaranteeing for your clients, is to be there when they have those claims happen. So when the rubber meets the road. So very important to look for a carrier that's been around doing this for this many years, because we've got that experience as well. All right, so what sets us apart? I mentioned this briefly, that we've got both a life and annuity-based solution. Again, we're going to only focus on annuities today, but what's great about the solutions that we have as well, we can either do a joint or a single life planning, and I'll talk through some of those avenues when we get into the annuity presentation. Variety of way of funding these. Now on the annuity side, really just kind of two. It's either a deposit because it's an annuity, or maybe a 1035 exchange. So really two different ways there. Again, on our life chassis, we've got a whole host of ways that we can fund these options. One thing that really sets us apart here at OneAmerica is the fact that we have an optional lifetime benefit rider, what we call our continuation of benefits rider, or COB, as you may hear me refer to it throughout this presentation. But we can do it for up to a lifetime. So for as long as any one, or if it's a joint case, for either one of those covered insureds, as long as they need care. That really puts the true peace of mind in when planning for any long-term care expenditures in the future. And then I'm going to touch on very reasonable underwriting guidelines that we've got here as well. So more on that to come here as well. But again, we're focusing on our annuity platform. So I really wanted to touch on the annuity marketplace. While some of these numbers may be a little older, they've only grown since then. And so if we look at total retirement annuity assets, we're talking over $2 trillion. So the market is huge out there for opportunities with planning for annuities for any of the long-term care planning that you may do with your clients. So just in 2020 alone, total annuity sales were $219 billion. So again, huge, huge marketplace. And if we look at what the average age of somebody buying any of those annuities, typically it's around 51, which really means if we're looking at using them for long-term care planning, they're probably not going to tap into those until 30, 35 years in the future, because the average age for claiming is between 80 and 85. So 30 years of growth around those annuities. So I just thought I would mention that as well. Now, if we look at the annuity marketplace and why people buy annuities in the first place, well, first and foremost, one is growth, right? They want to put their money into a safe space that will grow over time. What they really appreciate about that growth is the tax deferral. So they're not being taxed on any of that growth while, that deferral, while it's growing. So they get to defer those taxes until they actually need that. There could be a problem with that depending on how big the gain portion in those annuities happen to be, because when they do need to take any income from those annuities, they're going to be taxed on the gain portion. More on that in just a minute. Certainly they may want it for guaranteed lifetime income. So they can turn those annuities on at some point, and one of the options certainly would be a guaranteed lifetime income. But the fourth reason here as well is they may want to guard against catastrophic illnesses, and certainly in their retirement years. So that's really kind of around this whole long-term care planning concept. So there's a good question to ask for any of your clients. Do they have non-qualified annuities in their portfolio? And if they do, are they where they should be? More on that here in just a minute as well. Here's what I'm kind of getting at. So we did a Gallup poll here at OneAmerica a number of years ago and kind of asked non-qualified annuity owners what would really trigger them to use that annuity contract. 83% of them said it was their intention to use that annuity to avoid being a financial burden on their children. Here we are in Long-Term Care Awareness Month, and that's really what we're trying to educate on, is certainly making sure that people plan for these risks. And many times when they do plan, that is one of the main reasons that they do put a plan in place. They don't want to be a financial burden on their children. Well, another big reason that they thought that they would use these non-qualified annuities was to guard against that catastrophic illness. Again, the fourth reason of purchasing annuity in the first place, or against nursing home care. So really, again, the income for any long-term care expenditures in the future. So keep those in mind as we're going through here, because I'm going to kind of solidify some of that in and of itself. Now, I asked that question, is that annuity where it should be? And here's the reason why I say that. The pension protection, the federal government gave us a really good way to plan for long-term care needs with our clientele in the form of the Pension Protection Act, or PPA for short. And really what this allowed us to do, there's a number of things that the PPA did, but it really helped us in long-term care planning when it comes to annuities. Because essentially what it said is we can take what is a tax-deferred annuity, 1035 exchange it into a PPA eligible, Pension Protection Act eligible annuity. All of the annuities that we have here at OneAmerica are PPA, or Pension Protection Act eligible annuities. So if we just 1035 exchange that from where it happens to be currently, any of those non-qualified annuities will become tax-free for any long-term care expenditures. So a great win that the federal government did for us in using some of these existing non-qualified annuities out there by just exchanging them for a Pension Protection Act annuity. So what am I talking about here? Well, let's just give you some insight here. So, here's the cost basis that when they took that annuity out, whatever they paid for it, they paid with after-tax dollars, so that's not going to be taxable, right? But any of the gain, no matter how long they've had these contracts, there's going to be gain in them because they're annuity. They're going to grow over time. And all of that gain is deferred, tax deferred. So they don't pay the taxes until they actually take money out of those annuities. Well, what the Pension Protection Act said is, okay, well, here's a great way to plan for long-term care. Let's allow you to exchange, just 1035 exchange, that existing non-qualified annuity, put it into a PPA eligible annuity, and now all of that portion, so even the gain, the taxable portion, becomes income tax free if used for long-term care. So I love that slogan, tax deferred to tax free for LTC. Just a great way to do this, and I'm going to give you some ideas around planning with your clients in this as well. Now, not only can we 1035 exchange that and make it all income tax free for long-term care purposes, but we can also add our optional continuation of benefits rider. Remember I talked about that, where we've got a continuation of benefits rider that can go for up to a lifetime. So no matter how long they need it, that income stream will be there for any of those expenditures. So I thought I would really hit on the Pension Protection Act as well. Now, if we want to look at the whole concept of taking a deferred annuity with long-term care benefits, this is what it looks like. So here's a very well-balanced portfolio, right? You've got your aggressive funds meant for, large growth, but comes with a fair amount of risk as well. You've got your moderate, still poised for growth, but not as much risk. Then you've got your conservative funds here that are really meant to preserve capital. Typically, they all come with guarantees. So here's the concept of what we're doing with long-term care benefits with a deferred annuity. So essentially what we're going to do is just peel off a portion of that portfolio. So maybe take that annuity that they've had for years and use it and put it in for any long-term care planning purposes. So we'll take some of that, we'll leverage it up. So take that cash value, and then we'll leverage it for any long-term care purposes or expenditures. And then again, we can add that continuation of benefits rider for one, or if it's a joint case, for both individuals on the plan, and create it for a lifetime of expenses to be paid. And again, that would all be tax-free since we're using it for long-term care purposes. So hopefully you understand that's the concept that we're doing here. So I'll get into really how it works here in just a minute, but I really wanted to give you three main reasons that we move from kind of our life chassis, which we call asset care, into our annuity care chassis. So I'm going to look at those three main reasons. First and foremost is age. So we understand that some people either fail to plan, or again, I'm going to give you some ideas why maybe even if they've got a long-term care plan, you may want to look at the annuities in their current portfolio. Well, we can plan all the way up to age 85. And as a matter of fact, on our original annuity care, we've actually got three different solutions in the platform. But on our original annuity care, if we do a base only, so not adding the COB, we can actually go up to age 87 for planning purposes. Now, you just don't find too many long-term care planning resources that you can go all the way up to age 87. So issue ages are really one of the main reasons that we're looking at, or one of the three main reasons that we're looking at annuity care. The second one is health. And because this is annuity, yes, there is still some underwriting, but really 5 knockout questions, and I'll show you those towards the end of this presentation. If we add that COB rider, that will really trigger a cognitive screen as well. So there will be a telephone interview besides those 5 questions, but we're not going to have labs or paramedics or medical records, anything of that nature. We just answer the 5 knockout questions. If we add the COB, we have that telephone cognitive screening as well. We'll do a script check, an MIB check, and then it's basically accept or reject. So any health issues, so if they've already got a fairly long laundry list, maybe of some health issues, as long as they can answer no to those 5 knockout questions, which I'll give you here at the end, that might be another reason that we look to our annuity care suite. As a matter of fact, even if they come in on asset care or life-based chassis, and we're not able to offer them that particular solution, our underwriters will automatically look at our annuity care suite and say, can we place this with one of our annuities? So you'll receive some of that information as well through the underwriting process. So that's the second reason of 3. The third reason is really for what I was talking about earlier with the Pension Protection Act. Why not take an existing non-qualified annuity and do a tax play with your clients? No client wants to pay more taxes out there. So the more we can just 1035 exchange into a Pension Protection Act eligible annuity, and then if they access that for any long-term care purposes, it'll all be tax-free, even that gain portion that was deferred from original purchase reasons. So those 3 reasons are really why we look at the annuity care suite. All right, now that you know that, I want to kind of give you how it works, right? So pretty straightforward. It's just a simple concept. It's a base policy, and the base policy, since we're focusing on our annuity chassis here, is an annuity. Again, we call it annuity care, but it's a base annuity that your clients then will use in case any long-term care expenses come up in the future. So the first day of claim, you'll see that we're going to go to the cash value of that base policy and start drawing those LTC expenditures or the benefits out of there from that base policy. Now, we can also add what I call this a rider, so a base plus a rider. The rider is that continuation of benefits, and what that will do, if they exhaust that base policy, that's when the COB rider will kick in and continue that same income stream that they were getting out of the base policy for either a limited portion, or again, what sets us apart in this long-term care planning space is the fact that we've got a unlimited continuation of benefits rider, so it will go on for as long as they will ever need. So very simple concept, base annuity plus continuation of benefits rider. So hopefully that makes a lot of sense. Again, first day of claim, they're going to invade their base policy until those benefits are used. That's when the COB rider would kick in if we added that. Okay, moving in, I wanted to look at really the platform in and of itself. We've got 3 different ones. I'm going to start with our original, which we first started selling back in 1998. And it's just what we call Annuity Care 1 or Original Annuity Care or just Annuity Care. So sorry for the confusion there, but yes, it's the original Annuity Care as we sold it. So issue ages from 50 to age 85. And like I said, if it's a base only solution, so not adding that COB, we can go all the way up to age 87. So for those that failed to plan, for those that maybe want to 1035 exchange existing annuities and get tax-free benefits, this is the way to do it. It's a 7-day elimination period. So each one of these iterations are a little bit different in their makeup. So I'm kind of going through this. It gets a little wordy towards the end, but that's why I'm trying to take it one at a time. It's a fixed annuity. There's no internal charges. It's ideal for either single or joint cases. Now that base policy is a 36-month payout. So whatever the cash value of the annuity is at the time of claim, that's what's going to pay out over 36 months. And I'll get into that here just a little bit when I get into some examples. Next, let's look at Annuity Care 2. This one is probably the simplest of them all, in my opinion, because it's a straight leverage play, but there are some differences here. You'll notice, first and foremost, the issue ages from 40 up to age 80. So this one, just like our life chassis, the max age is age 80. It does have a 90-day elimination period versus the 7-day elimination period on original annuity care. It's a 24-month base rider. Reason that we did that, we wanted to maximize the LTC benefits, if you will, by suppressing the amount of time that it pays out. It maximizes those LTC benefits, right? If we've got a joint scenario, then it pays out over 30 months. So a little bit of a variation there. Now, this is a straight leverage play, so it really depends on what age they take out, this particular solution. So from those from 40 to 69, it's 4 times leverage, and I'll show you that in just a minute. So great way. It's a straight leverage play. They give us 100,000. We're going to give them 400,000 pool to draw from. So pretty straightforward leverage play. If they are from 70 to age 80, it is 2.5 times leverage. So still very flexible, great way to leverage the amount that they're putting in, but it's just not quite as much as those up to age 69. There is some fixed internal charges to pay for the COB, because this is the only solution where the continuation of benefits rider is actually added to the policy, and that's what really gives us our leverage. And I'll get into that, show you a little bit more when we get into the makeup. But it's ideal for more of the single insureds, if you will. The last one is an indexed solution. So I wanted to quickly show that as well. You know, there are a lot of clients out there that say, hey, the market's, well, lately the market's been a little more tumultuous, or in flux, if you will. But they want to take advantage of any upside gains in the market, but no downside risk. And that's exactly what an indexed annuity was created for. They can choose from one of 5 crediting strategies based on the S&P 500 and participate in the growth, but no downside risk. So that's an index strategy. Still a fixed annuity, no internal charges. Again, we're back to some different issue ages, 40 to age 85, and a different elimination period of 60 days. Same as far as the base annuity is attributable. So if it's a single individual, it's going to be a 24-month base. If it is a joint, it's going to be a 30-month base. This is, again, ideal for joints, largely due to that lifetime income rider as well. So a lot there on this slide. I'll get more into those as we look forward. So let's look at original annuity care. I kind of went through some of this information already, but you know, it can take a cash lump sum, so a single deposit, if you will. We can take any of those non-qualified annuities and do a 1035 exchange. We can take cash value and 1035 exchange it as well from a life insurance policy. We can even take qualified money here. I don't recommend that as much. I would rather see that on an option that we have on our life chassis, but qualified money we can take here as well. If it's just a base only contract, and I've mentioned that in and of itself, then there's no telephone interview. It's just the 5 knockout questions. We do a script check, an MIB check, and then it's accept or reject. Now, we can add that COB rider, and there's 2 choices here. We can double it, so extend it for another 36 months, or add that lifetime unlimited COB rider. Now, if I look at, focus on the Pension Protection Act again, I want to put some numbers. You recognize the slide, but I wanted to put some numbers to what we had here. And I'm going to even remove the continuation of benefits rider. I'm going to focus on a base only solution here. And why I think it's very important maybe that you talk to your clients about this. Let's utilize the Pension Protection Act. They've got an existing non-qualified annuity out there. Let's say they paid $50,000 for it. But over the years, it has gained another $100,000. But that $100,000 is all going to be taxable when they pull that out to use. And if that's their solution, kind of like what we talked about with the Harris or the Gallup poll that we did, if they're planning to use that for any long-term care purposes, why not 1035 exchange that and make it all income tax free? It just makes a lot of sense to me, even if they've already got maybe a traditional long-term care plan in place, even a hybrid solution like any of our asset-based. I just think that if they've got an existing non-qualified annuity out there with any amount of gain, the wisest thing to do would be to 1035 exchange that and let that be that tax play for those clients, make it all income tax free for any long-term care. So let me give you just a quick idea around this. So here we've got a single female, age 66. She had a current annuity, and I'm going to take those same numbers from the slide previous here. So it's worth $150,000 now. Again, remember, $50,000 she put in, but $100,000 in gain. So we just do that 1035 exchange, and what did that give her? So it's going to pay out that $150,000 over 36 months. But this is just the start. So we may look at this and say, well, 43, 48, that's really not that great of a benefit. Now remember, these are annuities, so they're going to continue to grow. And as a matter of fact, tomorrow our rates change again on our annuities, and again they've increased. So we're seeing rising interest rates, and that's really helping with the annuity marketplace, and certainly helps with long-term care annuities as well. So we're seeing some rises on that. So let's just say, okay, she's 66. I'm going to say in 15 years, let's look at what the benefits look like that after all the years of growth. Now there's a guaranteed amount of 2.55% in this particular annuity, but the current assumptions right now are at 4.75, although tomorrow they go up to 5% level. So increasing again. But when I first ran this, it was before we had the new rates, if you will. But look at what that amount has grown from, 43, 48, what we were originally thinking. Now, when she actually needs the care, look at what those amounts have grown to. If we just focus on the guaranteed amount, it's grown to over $7,000 per month for that 36 months. If we're looking at the current assumptions, what we're currently seeing in the marketplace, that's grown to over $8,700 per month in a monthly benefit. So really keep that in mind when we're looking at these types of, oops, I'm getting some strange things going on here. Brittany, are you seeing that as well?
Looks like you just went back into your editing mode.
All right, let's see if I can get out of this. I think maybe it's pulling from a different area. I apologize for this. Bear with me a moment. And let's show this one. Why is this doing that? That's very strange. Let's just go back and do this. Okay. All right. Hopefully that has it corrected. You're seeing that too, Brittany?
We're good.
All right. Excellent. Perfect. Sorry about the difficulties there, but that's technology for you. All right. So let's move on and look at annuity care on a female age 51. Now we're going to pay for a base policy plus the rider all in one in this particular solution. So let's look at that. So she has a current annuity. Now, even if she didn't have a current annuity, she just wanted to put a deposit of $125,000 down. This is what it would look like. And we're going to pay for both the base policy and the lifetime continuation of benefits rider. So with that, either deposit or 1035 exchange, we're going to split that between the base annuity and the continuation of benefits rider. So you can see 92,000, well, over 92,000 goes to that base policy, but then another 32,000 or over that goes to the COB rider. Now, what's that going to pay out in a monthly benefit? Well, $26.84. So I don't necessarily like this way of doing it. It makes it very simple. It's a one and done solution, but I would rather see that client pay for that COB rider separately and put most of that money towards the base policy. So let me show you what I'm talking about here. So same client, but we're going to annual pay that COB rider versus splitting it between the two. So we'll put that full $125,000 into the base policy. So full 125,000 comes into the base policy, but we're going to create an annual premium. Again, remember, she's 81, an annual premium of $54.60 for that COB rider to pay out for as long as she would ever need. What that does is it changes the benefit structure. So she's getting like 11,000 more in an annual benefit because all of that went to the base policy, or another $1,000 of monthly benefit. And why I think this is so important is, let's say she never needs this. Well, because these are all guaranteed, guaranteed amounts, the insured will pass that on to any named beneficiary should they never need to access this particular annuity, and all of the annuities on the platform that we're talking about here. So she's going to pass on the full 125 plus any growth that was there. The premium that she's paying is just more after tax. And that's where I say I think it's more beneficial to keep more of that money for themselves in case they never need it, and pass it on to their named beneficiaries. Now, you may say, well, why do I want to pay an extra premium? Well, I just think that in case they never need it, it is more beneficial to pass more of that along to their beneficiaries. So that's why I kind of give you that annual pay structure. I'm going to look at this at a different age bracket in our indexed annuity care solutions, so it may look a little bit different for you as well here. But next, I want to get into annuity care too. I kind of walk through the parameters. Again, issue ages 40 to 80. It varies whether it's a single or a joint policy on that base policy, right? 24 or 30 months. But this is the one where we automatically build in the continuation of benefits. So it's your straight leverage play. Pretty simple there. Now, one of the things you have to keep in mind, because we're building that COB in, there are some internal charges that come out of the cash value of that annuity to fund the COB rider. Not anything more they'll have to pay, but it's coming from that the cash value in that annuity, if you will. And because we've got that continuation of benefits rider built in, there's always going to be that telephone interview, more that cognitive screen, if you will, because this is the only solution where we've got the COB built in. Well, let's look at a pretty simple illustration here. Female, age 65, she has 100,000, and again, it could be just a single deposit, or it could be a current annuity that we want to just 1035 exchange. So we're going to use that for both the base policy and the COB rider that's built in. So what did that give this particular female? $4,200 in a monthly benefit, or over $50,000 annually for up to 96 months, so 8 years here. So is that a good way of planning? I certainly think it is, but remember, this is just to start. She's only 65. Again, these annuities are going to continue to grow, and with these interest rates that we have that are rising, they'll grow a much larger amount. So, you know, in say 15 to 20 years, when she actually may need this, that number is going to change. I didn't add those numbers into this particular slide, but just remember, these are all annuities. They're going to grow in their benefits as well. All right, so pretty straightforward there, right? That was your leverage play. 4 times leverage. Let me go back there one last time. So again, she gave us 100,000. Essentially, what she's got there is 400,000 now to use over 96-month period. So your straight leverage play, pretty simple, easy to understand, easy to explain. Last solution that we've got here is our indexed annuity care. And again, varies just a little bit differently, like I went through before. We're back to up to age 85 as far as the top end, if you will. Again, good for single or joint. It is a fixed indexed annuity, so they can participate in any of the gains in the S&P 500. They've got 5 strategies that we can choose from: your caps, your pars, and a fixed account. And then so they'll participate in any of the growth because of that. Plus, there is another piece that we're doing with this indexed annuity care solution that kind of acts like inflation, and it's a built-in multiplier that we have for the LTC benefit portion that will automatically grow here as well. So this is another great way of putting another annuity idea or solution in front of your clients. This one's a little bit more involved. We've got a few more strategies when it comes to adding a continuation of benefits rider, so we can basically double the base policy, triple the base policy, or add that, again, that lifetime unlimited COB rider as well. So I'm going to look at both a single pay for both base and rider solution and give you that single pay for all in the base and then annual pay the rider. So let's start with female age 70 here. And again, we're going to spread this $150,000 in her current annuity between both the base and the rider. So all that goes to the base policy. Excuse me, I shouldn't say that. The base policy comes over and pays for both of these. So you can see that that $150,000 gets split between both the base policy and the COB rider. So $112,418 to the base policy, $37,582 to pay for that COB lifetime rider. So what will that get her? $43.73 as a monthly benefit, or $56,772 as an annual benefit for as long as she will ever need care. And remember, she's only age 70. So again, these amounts will continue to grow over time. Now let's look at that, though. I still like this where we put most of that money into the base policy and annual pay that rider, because I want to look at just the difference here. So if we put the whole $150,000 into the base policy and then create that annual premium going forward, it certainly beefs up those benefits. And again, this is just the period to start. This will grow over time as well. But now, because we're going to annual pay that COB rider, we can see that the monthly and annual benefits amount has gone up. What I will say too, waiver premium will kick in as soon as they get into the continuation of benefits portion. So while they're still receiving benefits from their base policy, they will have to pay that annual premium. But once they're into the COB portion of that policy, waiver will kick in, no further premiums are due. And that goes through out all of our annuity solutions. All right, couple quick things I wanted to do before I wrap up here. Wanted to talk about 1035 exchanges and what happens if you've got an individually owned non-qualified annuity or a jointly owned non-qualified annuity. There are some rules that you have to follow when it comes to 1035 exchanges. It must be like for like. So if we've got, and we find a lot of these out there, singly owned non-qualified annuities that we now want to 1035 exchange into one of our annuity care solutions, but we really want to cover the spouse as well. Well, we've got something where we can do just that. We'll 1035 it over. It'll still be singly owned by whichever spouse had that particular policy, but we can add an eligible person. And by doing so, now we have joint access to that full annuity. So great way to get all the benefits out of that annuity that grew tax deferred, all tax free. And we see a lot of this adding that spouse to that singly owned annuity and making sure we maximize the taxation benefits, if you will. Now, if it was a jointly owned, we just 1035 exchange it, and it still must be jointly owned there as well. So like to mention that eligible person provision, that really helps in planning purposes as well. Next, I wanted to focus on really a wrap up here with underwriting and what we've got here when it comes to annuity care. Underwriting is a lot less invasive, right? So no paramed exams, no APSs. That's really the long pole in any tent, if you will, when we have to go out and get an attending physician statement. So no APS is needed for this. If they do add that continuation of benefits rider, again, remember, there will be that cognitive screen, so a brief phone interview will be necessary as well. But if it's a base only solution, again, we don't need that telephone interview even. Lastly, I wanted to wrap up with those knockout questions, if you will. So much easier underwriting than, say, our life chassis, if you will. So for those with more health history, for those, maybe planning later in life, that sort of thing, really wanted to focus on these knockout questions, and that's essentially what they are. So the first question here really is, do you currently use any mechanical devices? So wheelchair, walker, oxygen, quad cane, motorized scooter, these are all long-term care really related questions. Second question, do they currently need or receive help in doing any of their following, any of the activities of daily living, if you will, bathing, eating, dressing, toileting, transferring, or maintaining their continence? The third question, do they currently have or have they been diagnosed with Alzheimer's, dementia, multiple sclerosis, muscular dystrophy, Parkinson's? Again, all these long-term care questions, if you will, where those long-term care claims come in. The fourth question, have they ever been diagnosed with AIDS or AIDS-related disorders? HIV, we've actually taken out of the questions. They will be underwritten if they have HIV, but your knockout is if they've got AIDS or AIDS-related conditions. And are they currently receiving, or have they ever received Social Security disability income benefits? So those are your 5 knockout questions. If they can answer no to all 5 of those questions, again, we'll do a script check. So RX check, check the prescription database. We'll do an MIB, Medical Information Bureau check. And if all of these are congruent, then we typically turn these around in 72 hours. Now, if we're 1035 exchanging, that may add a little bit of time just because we've got to get that amount from the surrendering company as well. But great way to plan for any long-term care benefits, even if your client already has a long-term care plan in place. Because if they've got an annuity, a non-qualified annuity with any amount of gains out there, especially if they're outside of surrender charges, I think it behooves you to mention what is available here and why not tap into that first. And the reason I say that is, let's get all those tax-free benefits as quickly as possible. And we don't coordinate benefits with other policies. So it's not like they can't coordinate on any other, even if it's another policy with us, we're not going to coordinate those benefits. So I just think it's vital if your clients have that an existing non-qualified annuity with any amount of gains, really to mention this solution. So with that, before I wrap up, I thought this was kind of nifty, so I wanted to just play this for you really quick. So with OneAmerica, again, everything's stable, secure, and guaranteed. So bodes well for your clientele. So with that, Brittany, whoops, I thought I paused that. I apologize here. Let me kick it on to the next one. We're going to open it up for any questions that happen to have arisen.
Yes, and we do have questions. So the first one I'll go ahead and tackle. Unfortunately, OneAmerica's not only annuity care, but overall portfolio, including other hybrid tax qualified long-term care solutions, are not considered partnership qualified. Unfortunately, the state government just doesn't recognize this type of protection yet. So if you have folks looking for that partnership qualification or protection from the asset spend down for Medicaid, you will still need to stick with those standalone traditional long-term care insurance solutions. Brent, next I'm going to have you tackle this one. Can you
Brittany,
go and
add something to that really quickly?
Yeah, of course.
It was a great description, but I would also like to add, because we have that unlimited COB rider, continuation of benefits rider, that's another reason really where partnership just is, it really doesn't matter. Largely because they're going to have a guaranteed income stream for as long as they would ever need. And again, that can be a single individual or a joint case. So thought I would just add that.
Yes, good point. So Brent, I'm actually going to have you tackle this one. Can you go a little bit more in depth on the use of qualified funds and why you wouldn't necessarily recommend that for this product?
Yeah, I'll give you really two main reasons. First and foremost, we've got a great solution on our life chassis, where we give that qualified amount, a 25% bonus right off the top. We split that out into 10 equal parts then. So they're going to get that great 25% bonus. We're going to split it out into 10 equal parts. So we're going to maximize the distribution of any of that taxation that happens. So that's one main reason. The other main reason is, most, at least advisors, insurance professionals know that long-term care benefits are all tax-free. If we're using qualified benefits or qualified, say, annuities for funding this type of solution, or any qualified source for that matter, what's going to happen is we still need to pay the taxes on that qualified amount. So through that base policy, there will be benefits that are still going to be taxed because they're using qualified funds. And for that main reason, I think even many consumers out there understand that LTC benefits are tax-free. So all of a sudden now they're saying, well, why am I being taxed for an LTC benefit here? And that's one of the other main reason that I really don't like to use qualified funds in our annuity suite. So hopefully that answers your question.
Yes, and I do have to agree. For those of you asking about qualified funding, give our team a call, because we truly kind of use our foot first for the annuity funded asset care. Not only are you getting that bonus on top of it, it's leveraging the taxation over that 10-year benefit period, 10-year premium period. So definitely call the team. We can talk more in detail on that. All right, next up, training. Now, most of you on the call are probably aware, in most states, long-term care CE certification is required. That's still going to be true of the annuity care portfolio. However, because we are dealing with an annuity chassis, if your state requires it, annuity suitability or best interest training is also required, as well as product training. Now, that product training, we can just send you the link, pretty easy to get through, but there's just some additional steps licensing-wise out there for you folks interested in taking an application on the annuity care portfolio. All right, let's see here, Brent. All right, I think that wraps us up for questions. If you do happen to think of questions after the call, of course, give our team a call as well. But first, want to say thank you to everyone joining us today. Also, Brent, big thank you for co-piloting today's session. Again, if you still have questions or would like a one-on-one discussion, feel free to reach out to our team. Number here is 800-228-0008. Or shoot us an email at ltci@jetter.com. Everyone, I hope you enjoy the rest of your day. Again, thank you for attending. Bye-bye.
Thank you, Brittany. Appreciate it, everybody.